Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
All right, here we go. We're going to dive right in. You want to talk about money funds first?
Yep. So banking issue, the first part of our presentation from a few weeks ago and today focused on the issues that are happening in the banking world that are continuing to happen. Actually, it's not something that has happened and it's gone and we're moving on here, which will show, in which the data shows, but it continues to happen. So this chart really is showing the flow of money from or into, what is this, money market fund. So the flow of money into money market funds. And where does that cash come from? Deposits, right? Our bank deposits.
Disintermediation coming out of the banks and into the money markets, like what we hold for you at Pershing. Right. And one of the things we want to point out here is money's fleeing into government-backed paper. Now, it was in, I always forget the date, Paul, but it was like, what, 5-6 years ago?
2016.
Okay, wow, time flies. 7 years ago, when they passed a law that they will only back government-backed money markets, dollar for dollar. Anything other than a government-backed money market can break the buck. Mm-hmm. So one of the things that you know that we have here is that when we have a money market, we want dollar for dollar. So what you're seeing now, and at that time, Paul and I were under this discussion about why they would do this.
Why would they do that?
And we think they do this to herd everybody into, I mean, very frankly, herd everybody into one place, into the treasury. Herd everybody into the government-backed securities, which is concerning. Why? We don't know. Hopefully it's not a whatever. But anyway, so at this point, dollar for dollar.
There's two different types of money market funds. The government, which can only be invested in super short-term government paper or agencies or even government-backed repos. It just has to be backed 100% by the government, as opposed to prime money market funds, which can invest in corporate overnight paper and a whole bunch of other more exotic or just more different instruments that can provide a slightly higher yield.
And one of the things that Paul and I talked back then about is how they're going to herd everybody into this asset class for a number of reasons to support our paper, right? So if everybody's herding in this direction, or, you know, we're following the herd, right? And we're going in this direction, it's why? Is it because if you really look at the global landscape, the United States is losing its favor globally. And so therefore there's less inclination by other countries to buy our paper, right?
The easiest way to think of it, more money into money market means more demand for U.S. government debt.
Yeah. So, you know, we are supporting it. So in the meantime, you have to understand from our perspective, once that law went into place, frankly, we switched, you know, even though you can get a higher yield in a corporate backed money market, we said we won't take a chance in money market.
Do you really want to risk your cash?
No,
right?
no,
I mean, it's supposed to be one of
the
safest things. Right? Stocks, and you know, that's where your risk is, and even in bonds, but cash should be cash.
Yeah. All right. So let's go to the next slide here.
Yeah, and this just shows the flow here is accelerated. So it means there's more demand out there for these money market funds
to get out of banking, which is interesting because Paul noticed this weekend, and I noticed previously that Yellen made a comment, and this is disturbing. Okay, this is very disturbing that more regional banks will fail.
Yeah, she
then
flat out said that she expects more and more consolidation in this space.
Yeah, and one of the things,
Wait.
and one of the things that we want to point out to you is that we have had a theme since the beginning of this company that big is going to
Mhm.
get bigger. Well, is this an intent? I hate to say it, I'm just going to say it like it is. This is an intentional move to make things get bigger. You should see JP Morgan.
Yeah.
They're gonna, this last acquisition they made, their revenue is skyrocketing
Mhm.
because they bought a bank at 10 cents on a dollar.
And nobody else had access to that deal.
No one else had access to it. So if this is the case, that more regional banks will possibly fail and have to consolidate. So one of the things that I think we are at least a little bit calmed about is that they are making sure that the deposits are okay in these
Right.
institutions, and that's a big deal. However, but what's the big plan to really have only a few blank banks that have the control? I mean, this is sincerely a concern of ours. When we said that big is getting bigger, we weren't just talking about corporations. We're also talking about oligarchs, people, individuals who have more and more percentage of the wealth.
And less choice, less options for people.
Disturbing.
It's what makes us all worse.
It's crony capitalism. It's really, let's call it, call it what it is. Okay. Bank
So
reserves.
this speaks that where is all that, money coming from to pump up those money market funds? Is coming from bank reserves, which have hit a what is this chart? Small bank reserves is this black line. So small banks have gotten hit the hardest, which
Right.
we've seen, which is why there's been several failures. There's even larger banks reserves have gone down considerably.
And keep in mind, so what was it, 2020? So if any of you didn't listen to my talk on Silicon Valley Bank, please listen to it because it speaks to what Paul and I are talking about today. First of all, bank failures are never one-offs, never. The second thing is with each bank failure. So now this is my third or fourth, now I'm losing track. Let's see. We had one in 1990. We had some failures in in 2000. And then, so here's my fourth go around. This is fun. 36 years, 4 times I'm sitting in the same space where they make laws, they make rules. Okay. And Paul and I are all for thoughtful
regulation is necessary. It's needed. It's great.
thoughtful regulation.
If it's not
but-
thoughtful.
So they put in these, and I was all for it, these metrics, these guidelines for reserves. After each one of these events, they put these things in and then they roll them back.
Over time.
time.
Just say, actually, we don't need to do this. Actually, we don't need to do this. And then all the bad stuff happens again.
Anyway, I'm really hopeful this is the last go around that I see. All right, look at
Just
that.
wanted to show also, this is the BTFP. This is one of the programs that the Fed put in place so that banks who are struggling with flows made sure that they were able to make access funds essentially, right?
Yeah.
Not to get too into technical terms, but that's at the end of the day, that's what it's trying to do. If things were getting better in the banking space, you would start to see banks repay these loans, and the use of this facility should be coming down. Instead, it's going up.
Yeah, and this is a little dated. I mean, it's from the 8th. We can look at it again. That would be interesting. But always remember, the biggest thing from Paul and my perspective is the slope of the curve. Slope. So here we have like a little, let's say,
flattening, and now it's starting to tick back up. So it's something we're definitely paying close attention.
Yeah, and this speaks to the health of the banks, really.
And here's the
It's the
next
same
one. This
thing.
is the reverse repo, which is it's another facility that the Fed offers to provide liquidity to banks. And it still is elevated. And I think last week it hit a new high. It's pulled back slightly since then, but it's still at these very high levels.
And one of the things you need to know, again, this is the window that banks will go to keep themselves liquid. Okay, so you can see that that's, so obviously Janet Yellen knows something, but so do we. All right, lending conditions. I mean, this is
As a result of all of this happening, lending conditions at banks have deteriorated significantly. And right, so this is showing the net percent of banks tightening. That's the blue line says, and what tightening means is just that it's harder to borrow money for
Yeah.
the average person,
And-
or corporation or any.
Yeah, and keep in mind something really important. There's something we watch, which is called the senior loan survey. The senior loan survey is a survey by senior loan officers throughout the country, and it measures what the lending conditions look like. Is it tightening? Is it loosening? Are there delinquencies? Okay, so what we're seeing right now is a very big concern across the globe, across this country, around commercial real estate, offices and retail space. This is hitting big, especially in the large cities, and especially where they defunded the police. So this is for real. This isn't, you can look at the statistics that businesses are moving out of those locations because crime is increasing. So this is a real issue
Yeah,
that's taking
there's so
place.
many systemic issues here. You pair that with a piece of it is the work from home, or just the changing in mentalities
Mhm.
too, where you had banks holding these positions on their, or these buildings on their books that were at these inflated values.
Yeah.
And now they have 50, 70, whatever percent occupancy. That's way less than all of their projections said. And now their balance sheets and things just look so much worse.
Yeah, it does. Yeah, so it's going to be curious to see where this all ends up. The other thing is CNI, which is the loans like for research, development, such like that to industry. That also is softening. Those standards are tightening. And keep in mind, money is it's the oil of the engine, right? It's what keeps the pistons going. So we need those pistons going. And we're not saying that we want money to be easy. That's not an answer. And I think that's what led to this problem. But be smart about what you're doing. So you're saying that regional banks are going to be under stress, and you're raising interest rates.
Put them under even more stress.
And
Does that
then-
make sense?
And then you also have this window that's flush with capital for some banks, not all. So I don't know, Paul.
Sorry.
Yeah. Unemployment claims, that
Yeah, we touched on this. They came up last week. Again, the slope of the curve it's still low, but it is hitting a new high. It hit a new high it hasn't been at since the end of 2021. So it's just something to pay attention to again.
and we do know, and I think you also know that there's been layoffs a lot in the technology space last year in particular. So hopefully that's slowing. This is
the producer price index. So it's what the cost that producers pay to
for their
get
raw
goods
material.
and materials, right? And you can see that it come down considerably. So what this would tell me, if I was at the Fed, that hey, we've done our job.
Yeah, we've done our job.
I mean,
let's at
let's
least
pause.
pause. Let's at least pause.
Mhm.
Let's hope that's.
Are they pausing?
They didn't yet. Let's hope they do. I apologize, I said this. If they don't want it, this is before we saw the first bank failure, Silicon Valley Bank. I mean, we were bold and we said if the Fed doesn't stop raising rates, it's intentional. They're looking for a problem. So hopefully they're not. Let's hope we're really wrong. This is import export price. Same.
Getting down.
Mhm.
So it would say this is data that would all warrant a pause.
A pause.
Okay, let's.
And again, I think we have another chart. The next one probably shows necessities,
Yep.
right? Yeah, so we'll speak to that. Like, okay, you can go to the next one while I talk, Paul. There's definitely, let's say, a lower price in a lot of the things, the discretionary items, but still in the non-discretionary items, other than energy, which has had it go down.
These next two charts
Mhm.
really speak to this point. As you can see here, right, the cost of energy has come down considerably from
Mhm.
gasoline and natural gas to electricity. Huge drop here. But when you look at the rest of the basket, less electricity, apparel, shelter, medical care, education, services, less energy, food away from home, all these things are still trending higher. And so when you average those together, it looks like, oh yeah, inflation has stopped. Well, wait a second. The cost of energy has come down, but the cost that we're paying for things is still up, and it's still more.
And we're still paying. Yeah, okay. I do have some good news, while you do this. I mean, I'm happy to see that they're actually, they're actually going to replenish the Strategic Petroleum Reserve. And that was just announced this, I think, the end of last week, which,
Something we have been concerned about.
yeah, and it doesn't mean they're doing all of it, but they're at least doing some, so. Yeah.
Especially with energy prices down.
Yeah.
It would make sense. This is a good
Yeah.
time to.
Yeah.
probably do that.
All right.
All right.
So credit default.
Yeah,
swaps.
credit default swaps. So I couldn't get a good chart to update this because the 1 year has actually spiked higher than this point. But the 5 year has over the last day or two has come
Come
down,
down, yeah.
which is
Yeah.
generally a
Definitely.
good sign. But again, credit default swaps, spreads, these are a sort of insurance vehicle on whether the underlying is going to go bankrupt. And so the price of these things goes up if the risk of default increases. And so you can see during previous crises or times of turmoil, Lehman collapsed, US CDS spreads spiked when the US was downgraded from AAA to AA, CDS spiked the last debt crisis in 2013.
Which was really not really a debt, it was a debt ceiling, it was just a whole debt ceiling issue.
Spiked
And yeah.
sovereign credit risk.
yeah, that was.
2015, right? There were a lot of issues in those markets then. And it sort of hit a new high that it's never been.
Yeah, and again, debt ceiling issues, right? So I liken this to that phenomenon and not necessarily to issues yet in
Yeah.
industry.
Mhm.
Okay, so that's really, so this is
It's the
more,
key point.
yeah, more to do with the psychology, the fear of what's happening with the debt ceiling in the conversations they're having in Washington than it has to do with the underlying fundamentals. Because if you break apart the industries right now, you're not seeing all of them spike like this at all.
And it can spike too, because large corporations or institutions can buy these vehicles and sort of bid up the price as a very, very small piece of their portfolio to hedge against
Yeah.
just future uncertainty.
Mhm,
And so that could be a piece of why this is spiking so much, but
Yep.
more and more people do something to pay attention
Mhm.
to.
The US dollar.
US
Okay.
dollar, right?
Yeah, this is the long-term theme Paul and I talked about. You can see that it's in a
Chart goes
long,
back to 1968.
yeah. Long-term downtrend. We talked about how the dollar spiked recently because we were the only country raising interest rates. Now other countries around the globe are. Again, we think the dollar is at risk. You can see it. We've talked about it a lot about the petrodollar and the fact that more and more countries are trading outside of the US dollar. Supply and demand, remember, supply and demand. If the supply is high, demand is low, that brings down the value of anything, anything. So this is something we watch and we're concerned about because if the world moves away en masse from the dollar, then we could almost be rest assured that prices will go substantially higher in this country.
And this is something we've been tracking for years and years, and we are seeing sort of an uptick in the frequency of other countries trying to settle trade in their own currency or a different currency and move away from the US dollar. So these kind of transitions take a long time usually.
Yeah, these are long-term trends.
Long-term trends, but we are noticing again.
Yeah.
Steepening of the curve,
Mhm.
if you will.
Gold,
Gold,
right there.
yeah,
You see those three peaks that Paul has the line across right there, boom, boom, boom. In order for us to really be fully bullish on gold, we would have to see it break above this. However, we did take a position mostly because of the geopolitical situation, what we see happening. It's a hedge against inflation, it's a hedge against turmoil. And you also see central banks
Right,
around
yeah.
the globe,
central banks had
This-
a new record, I think, are
Yeah.
buying gold up.
like Switzerland now, it's like they're really buying in a very large way. So
If all was well and good, you'd probably see this continue down and
Break
down and
down.
down or sideways.
Right. So this is at a really important inflection point. The more you see those peaks hit that line that Paul shows, the more you see this zigzag formation, the more solid, and he's going to actually draw it for you if you can. Okay, cool. The more, there you go. See,
It's not-
Good job. That's okay. Works for me. It's the point is there. That's awesome. Not an artist, but anyway.
It's a line, right? We can see it touches, boom,
Still works.
boom, boom, boom.
Yeah, the more you have to understand something in terms of patterning. Like I love patterns. Paul loves patterns. I would say we're into pattern recognition. That's really pattern recognition actually helps with the psychology of the market more than anything else. And it also pattern recognition helps us see things before they actually happen. So what we see here is if this pattern, if we saw a break above that line that Paul just put in to the high, basically gold will have what we call no overhead. It has hit an all-time high and it has no ceiling. Usually, not always, but usually any stock that has that formation, in this case, gold commodity, and it breaks above, typically means it would go parabolic from there. That's just experience.
Assuming conditions don't,
Right.
all the assumptions are in place and conditions stay the same that allowed it to break. Assuming there's no change in that, sky's the limit.
And it's the same in terms of a breakdown to the other side as well.
Nice little technical lesson.
Yeah, and not to be discounted, because these types of patterning, these are the things that actually help call certain trends like the tech bubble, financial crisis, and today or last year. Oh, wow, that's it. Okay, so do we have questions? Let's see, anybody want to raise your hand and ask? You go right into the chat box, or you can ask some questions.
Wait, there was some questions last time where
Do you remember
I
them?
think one of them was what to do, how to invest to generate yield or something like that in this environment. And that is a great personal question, so come give us a call.
Yeah, yeah, there was, I mean, one of the things that you have to understand is we still aren't extending our maturities in this environment. There may come a point where we would extend our bonds. We just have to see certain things take place for us to say, yeah, we want to extend. We've seen some really bizarre, and I'm going to say bizarre because I've seen this a few times, but I don't even think I've seen it in the financial crisis, to be honest with you. But we've seen some trades on the treasury, like the 1 year, for example, even the 1 month, Paul.
Yeah, the 1 month, the volatility is super uncommon.
Yeah,
you don't see this.
You don't typically see this in treasury. So hopefully that's not, when I see that type of volatility, it usually means there's something under the surface. So we don't see anybody raising hands here. If you wanted to, so any of you feel free to just give Paul or I a call, and we are more than happy to talk through your specific situation with you. And I think that's really it. So, well, you know what, wait, just let us, we are still conservative with the portfolio.
I was just gonna say,
Yeah,
overview of our
let's just,
sort of positioning.
yeah, we are still conservative. We have been buying some of these 5%, 5.5% treasuries for your portfolio, because why not? And we are a big believer in what we call the bugs. So that's the big companies we won't share necessarily with
Big
you.
mega caps.
The big big ugly.
Big ugly mega cap.
Yeah, we have, but anyway, we call them the bugs. Those are the big companies like, Google and Amazon, and we do things.
Speaks to our consolidation themes, and they're
definitely.
they've sort of systemically embedded themselves into our current reality, or
Exactly.
they're not going anywhere.
Exactly.
In the short term.
All right, so I think that's it. And again, you know where to find us if you have any questions.
All right.
Okay,
Thank you.
Thank you,
Okay,
everyone. Take care.